Hello people, this is Dr. Wang here recording. I hope this video clip find everybody doing fine and safe. In this video clip, we are going to cover a new chapter. It is called cash budgeting. Cash budgeting is similar with the capital budgeting in terms of dealing with the cash flows. But cash budgeting deal with short term. Normally, the cash flows occur within a year. However, for capital budgeting, they usually last for more than 1 year or even 5 years or 10 years. In some of our capital budgeting cases, we are dealing with 20, 30-year project. So back to our topic, cash budgeting. Here is an example. So we're gonna work through this all together in Excel. That is a in-class exercise we need to do, and you're gonna submit it to the Canvas. The due date has already been posted there. So if you look at these numbers, these are cash flows in different months. So definitely you will be working on cash flows within a 1 year period. So that's a short term. So that fill into our category of cash budgeting. So you are going to create a cash budget table for June to September of a year for a company called Bithlo Barbecues. And here are the given pieces of information. So you have sales from April to October, and you need to analyze from June to September for all the cash flows. And this is the beginning part of the story, which are the sales. Okay, these are the expected sales. So I'm going to copy paste this into a Excel file. So let me just do it here. Copy paste. If you are uncomfortable with the copy paste, it's fine if you just type it in. And I'm going to write down sales. Let me zoom in a little bit so you guys can see it better. Okay, so here are your sales in different months. All right, so now let's talk about account receivable. So 40% of the sales are for cash. Of the remaining 60%, 75% is collected in the following month, and 25% collected 2 months after the sales. Okay, so basically you are looking at this structure. So when you have a sales, okay, let's say it's $100. So this sales is in April. So based on the provided condition, 40% of the money will be collected in April in cash, and then the remaining 60%, okay, 60%, 75% of it, okay, 75% of the 60, you can imagine that's a $45, will be collected in the months following, and then the other 25% of the 60% will be collected in the month after. Okay, so it's in June. Okay, so that's the structure. 100 sales in April, $40 will be collected in cash. Then among the rest is 60, 45 will be collected in May, and 15 will be collected in June. Okay. So how do we collect our bill? So let's say cash collection. Okay, I'm going to use 40% multiplied by this month's sales. Okay, then I will need to use a format painter. Okay, and then collection in month 1 in first month. Okay. Okay, so you see in the first month after April will be May, right? So it will be April sales multiplied by 60%. Yes, 60% multiplied by 75%. Okay, see 60% of the sales, 75% will be collected in the month following. Okay, and then I will do the format painter and drag it all the way. Well, I can basically extend it to November because a part of October sales will be collected in November. Okay, and also I can write a collection in second month after. So for April sales, the second month after April is June. So I'm going to use April sales multiplied by the remaining of the non-cash collection and multiplied by 15%. All right, so that's how much you receive in June for April sales. And then I drag it. You can see this is the money I receive in July for May sales. Okay, it's like 60% times 15%. That's roughly 9%. Okay, so just to drag it and use a format painter. All right. Well, I can extend it to December, but I don't need to do that because my analyzing period is from June to September. Okay, so the numbers here, I want to make it smaller. Okay, the font, make it smaller as well. Okay, so you will see the cash inflows all together. Okay, this 4 months are our analysis period. So I will put the summation of the three numbers, cash collection. So for my June's cash collection, it is made of 40% of a June sale, which is here, and this is from a May sales, and this is from April sales. Okay, so the money I receive in June come from the sales in June, in sales in May, and sales in April altogether. And then I'm going to drag it all the way. Okay, so that's for my cash inflows. And then I'm going to read part 3, raw materials inventory purchases are equal to 50% of the following month's sales, and 60% of the purchases are paid in the months following the purchase, and the remainder are paid in the following month. Okay, so what you see here is purchases. Okay, and the purchases equals to the 40% of 50% of the following month's sales. So if you are talking about the purchase in April, it is based on 50% of the sales in May. Okay, so if you are going to sell $35,000 worth of hamburgers, you need to buy $182,500 worth of inventory, like the raw meat, cheese, lettuce, and bread, and so on. Okay, and then I just drag it all the way. Okay, and for the cash payables, okay, so let's say for the payment in first month, it is not happening until the inventory was built, the purchase occurred after that. So it's 1 month after. So what I'd say is 60% of the purchases are paid in the month following the purchase. So I'm going to use a 60% here multiplied by the purchase in the month earlier. Okay, shrink the font, then drag it. And then also I have a payment in the second month, that's the month following that. Okay, so for April purchase, part of it will be paid in May and a part of it will be paid in June. So 40% of it will be paid in June. Okay, so this part of a collection, a payment in June is based on April sales. All right, so you have the total cash payment or cash outflows. Let's say maybe a cash payment is a better description. All right, so for our analysis month in our analysis, so it is a sum of the two. Okay, so really the cash collection and the payment matters instead of actual purchase amount and the sales amount. Okay, indeed, you made this much of purchase in June. However, you do not collect this much money until July and August. Okay, so for your cash payments in June, it is based on the sales, the purchase in May and also the purchase in April. Okay, as you can see, these are all connected. All right, now let's talk about a wage. Wages are forecasted to be equal to 20% of the expected sales. All right, now let's put a wage. This is the easy one. So it is 20% times the expected sales. Okay, just drag it. Okay, and then payments on leases of equipment are, this should be $10,000 per month. So this is a fixed payment. Okay, so lease of equipment. So that's the $10,000 per month. Let's drag the number. Okay, and the interest payment on long-term debt are due in June and September, and they each comes with 30,000. Okay. Okay, so June and September, 30,000 here, and 30,000 here. So these are your interest payment. Okay, and you also have 50,000 dividends paid in June. 50,000. Okay, so these are all the cashes occurring here. All right, and the tax payments are paid in June and September. 25,000. Okay, taxes. I hope you guys have filed your taxes in April. 25,000. And $200,000 is scheduled to be paid in July for capital investment, but management is flexible on the schedule of this outlay. Let's say invest outlay. So it is 200,000. Okay, happening in July, but it can be in June, it can be in August or September. It can be anywhere depending on the financial interest of the firm. And also, here is the most complicated part. The company has to keep a minimum cash balance of $15,000, and its ending cash balance at the end of May was $20,000. Okay, so right here we need to do a summary. Okay, let me just zoom out a little bit, and I'm going to lock the first row. I will do view, freeze panel, just freeze the top row. All right, so I will do a review here. I will see the total cash flow. Okay, for June to September, it is whatever cash you collected, your cash inflow in June, okay, minus the cash payment for your inventory, okay, then minus the summation of all of these, okay, you need to select all of them, okay, so it's the cash you collect in June minus the cash you paid for your purchases in the previous 2 months, and also deducted by all these expenses, dividend, taxes, and also capital expenditure. All right. Although some of them are left blank, you still have to select them. Okay. Okay, number 10. The company has to maintain a minimum cash balance of $15,000 by agreement with its bank. Well, definitely the bank has to impose certain covenant to prevent the managers from wasting the money. So in the previous module, we learned about a capital structure. We learned that bank has to prevent this kind of agency problems by enforcing some of the agreements. Anyways, back to this part 10, you will need to set up the minimum cash balance. So let's see the ending cash balance in May will be $20,000, okay, and it is also the beginning cash balance in June. All right, it's also the beginning cash balance in June. All right, the thing is you are losing money in June here, and if you incorporate that, then you will need to running a deficit. Okay, let's see unadjusted cash flow. The unadjusted cash flow would be this beginning balance plus whatever your total cash flow is in that month. Okay, and you are thinking, well, what should I do? Well, the thing is, there is a minimum cash balance of $15,000. Okay, just put it there. You may not use it for your calculation. So what do you need to do? Well, it says you need to calculate total borrowing. So that means if you're running short, you have to borrow from the short-term loan market or money market instead of borrowing from the bank, which forced you to pay interest in June and September. Well, this definitely is a long term. Okay, so to fill in the gap, you need to borrow short-term loans, okay, which is different than bank loans. All right, so how much money do you need to borrow? So you are running this much in short, so you definitely need to fill that gap, and then also increase from 0 to the minimum cash balance. So you will need to borrow this much, right? Okay, so this is a hole you need to fill. So you need to borrow that much, and that's not enough. You also need to borrow at $15,000. Let me just lock it. Okay. All right. So where does that lead you? So if you look at your borrowing in that month and your unadjusted cash flow, you would end up with this ending cash balance. So I'm going to add this 2. This will be my ending cash balance. All right, so for July, I'm going to drag the cell. So my ending balance of June is my beginning balance for July. And in July, I'm running a bigger hole. That's mainly from my capital expenditure, the investment outlay right here. So what do I need to do? Well, definitely this is gonna suck up all of my cash in there. So my unadjusted cash balance would be this plus the beginning cash balance. So I'm running a hole of $98,300, and then I need to borrow the money. So I need to borrow the negative this, and then plus this the 15 $1,000 minimum cash balance. So that's how much I need to borrow. Okay. So once again, this number, $113,300, come from the use of covering this hole of unadjusted cash flow, and also to add up my cash to a ending balance 15,000. So if I add these two numbers together, this will add up to 15,000. So my goal is end, and I listened to my bank. I said, hey, Mr. Banker, you see at the end of the month, I have just enough money to feed my people, $15,000 as you require. So I'm not milking my property here. All right, in August, the situation turned out to be a little bit better. Okay, so what you see is again, the beginning cash balance in August is the ending cash balance in July. The same rule applies. Actually, I can just drag it all the way there if I want. And in August, I'm running a pretty good surplus, and my unadjusted cash flow plus the cash I begin with would be 98,000 something. All right, and do I need to borrow? Well, does that fill my requirement of minimum cash balance? Yes. So do I need to borrow? No. Okay, so I will borrow no money right here. Okay, so what will be my ending cash balance? Okay, it is just how much ever I had for the unadjusted. All right, you will see the formula here is different depending on whether I need to borrow or not. And then in the next month, I run into another cash flow, positive cash flow. Okay, so that's 9,610. And right here, what should I do? Well, again, my ending balance of last year equals to the beginning balance of this year. Okay, and then my unadjusted cash balance. So this is I start with in September, and then this is how much money I make, and then that brings me to, well, above $100,000. Okay, and then my ending balance here would just be that, because I don't need to borrow since I have a surplus, and then my ending balance would be this unadjusted. Okay, so if I check the formulas, you will see that for June and July, it really is not quite the formulas will be the same because you are running a deficit, but for August and September you are running a surplus. The formulas are not the same. Okay. So here I want to show you something. Instead of having different formulas for ending cash balance and for the total amount of borrowing, I will use one formula. Okay, I will use the if statement. Okay, so I will use if statement. So basically, if I'm running a negative unadjusted, so let's say if the unadjusted cash balance cash flow, which combines how much money you had at the beginning and how much money you make and spend, so that's your unadjusted. If this is greater than 0. So you don't borrow, right? So you don't borrow at all. Okay, there's no need to borrow. But if it is less than 0, then you need to borrow to fill the gap. Okay, so that's our logic here. So how much do I need to borrow? Well, as I said, if this unadjusted cash flow is greater than 0, I don't need to borrow. But in this case, I have unadjusted cash balance in June that is negative 16,000 and something. I do have to borrow. So how much do I need to borrow? I will need to borrow the negative of that plus, okay? Well, the negative of 16,000, the negative of a negative 16,000 is a positive 16,000. So I'd have to borrow $16,000 to fill the hole, but that's just to make it a flat. I also need to maintain a minimum cash balance of 15,000 to meet the minimum requirement. So I put $15,000 there and also do F4. Okay, so this is my formula. So as you can see, my output does not quite change here. Okay, I just put the formula from either a number or a single formula to a complex if statement. All right, and what about my ending cash balance? It is the sum of unadjusted cash flow and borrowing, so this is good. So just to drag it so it does not change. And then my ending cash balance would just be whatever the beginning cash balance was. Okay, so it really doesn't change anything, as you can see. But the point here is I use all one formula to express this borrowing thing, and everything here are just a simple matter of dragging. So if I just drag them all, so all the formulas will be replicated. Okay, so if I just delete them to show my point, I just drag it all the way to September, and then they look correct. Okay. So right now, let's do the last assignment. You will also need to conduct a scenario analysis to find the amount of total borrowing if the capital investment is June, July, August, and September. So here, you will see that my total borrowing equals to the sum of all the borrowings in the 4 months, okay, which is a pretty large number. As I said, it's mainly due to the investment outlay over there because it just happened in the wrong time and it made me to a very bad situation of needing money badly. So can I just replace this investment outlay to August instead of July? So we can try it out. Well, the thing is, the less you borrow in total, then the less interest you pay. All right. So let me just cut and paste this to August. Does that change anything? Yes, it does. Okay. You see my total borrowing shrinked. All right. And if I change it to September, does that make it better? Yes, it does. You see my total borrowing also decreases here. Okay, so I think before I move on, I need to make the font a little bit nicer. So let me just select all of them and use a dollar format. Well, that's just too much. And then adjust the width of the column a little bit better. Well, I'm not sure if you guys want to see me. that much. So just to shrink myself. Okay, so now it's look nicer and more professional. So I can just delete the side notes here. Okay. Back to my work. So where should I do the capital outlay? It was set up in July. As you can see, the capital outlay was scheduled in July, but management is flexible about this money spent. So you can do it anywhere, and you want to know which months would be the best. Okay, so to do a scenario analysis on this one, you need to click on data, and then you need to do a what if analysis, and then you need to pick this scenario manager. All right, you need to add 4 different scenarios. The first scenario is outlay in June. That's one possibility. The second scenario is the outlay in July. The third is August. Fourth is September. All right, and then you need to observe the corresponding total borrowing under each of the scenario. All right, so you can just add the first scenario. You can say outlay in June, all right, by changing what sales. You may think, what about just this sale? All right, I make it either 0 or 200,000. But the thing is, you have to make all the 3 sales for this row change at the same time. Okay, so all 4 sales has to adjust for this scenario. So if it's outlay in June, then the number in E18 should be 200,000, and in all the other sales should be 0. Okay, so that's your first scenario. Then you add another one. This is outlay in July, still by changing the same sales. Then all the others are zeros except E18. All right, the investment outlay in July is leave as 200,000. Then you add another one, outlay in August. Then it's a 0 here. This will be moved down. Oops. Cut, paste. 0, 0. Okay. Then add another one. Outlay in September. Okay, so it's a 0, 0, 0, 200,000, and okay. So now you have 4 scenarios, and then you want to create the result table, and then you do summary, and you want the result sales to be this total borrowing. Okay, then you click OK. Now a new chart is created. So for this 4 sales, you can just retype them as a June, July, September. Sorry, my ranking is wrong. That's August. Okay, and you can also delete the chart, make it a little bit better looking. Okay, and this would be your total borrowing. Okay, the current values, you can just delete that because the current value is the outlay in July case. Okay, so you will see that if the outlay occurs in September, then your total borrowing will be the least. So you better wait until September until you have accumulated enough amount of cash in order to launch that major capital expenditure.